Hello, welcome to day 3 of the 2025 US Expats Financial Conference, sponsored by Expat Focus, the web's favorite destination for anyone moving or living abroad, and Wise, the leading provider of fast, low-cost international money transfer services and multi-currency accounts for individuals and businesses. We have a fantastic schedule for you, consisting of 9 sessions over 3 days, covering lots of aspects of financial information for Americans living abroad, with perspectives from some of the world's leading experts in their fields. Today is the third and final day of the conference, and for this, our second session of the day, I'm just delighted to be joined by Vincenzo VIllamina, founder and CEO at Online Taxman. We'll be discussing tax-saving strategies for US expats in 2025. Before we start, please bear in mind the information presented is for educational purposes only, and you should always seek your own personalized financial advice. Note also, while the conference is free to attend, if you'd like to leave a tip for the organizers, you can do so using the PayPal link I'll drop into the chat window at the foot of the screen. Vincenzo will be answering your questions at the end, so please add them in the Q&A pop-up and whenever you think of them, and we'll try to answer them all at the end, time permitting. So without further ado, over to you, Vincenzo.
Yes, no, thank you for having me, Hugo. I appreciate that. I'm going to share my screen. Okay. So let's get into it. So as you just said, I mean, nothing is, this is not advice. I do think that it's really important to seek advice, in particular talking about these strategies and knowing that every situation is unique and different. So, I know there's been other providers that people have covered sort of this notion of the fact that, by living, American living abroad obviously still needs to file their taxes. Of course, there are some, more standard strategies that are great, right? The foreign and income exclusion's an important one. If you qualify to earn $126,000 of earned income tax-free. Again, the foreign tax credit also important, so that you are getting a dollar-for-dollar credit for any taxes that you're paid outside the U.S. Whether it's on earned income, whether it's on passive income, and so making sure that that's buttoned up is important. And then, of course, look at the tax treaties, right? Things like income sourcing, where you should be paying tax, whether it's locally or in the U.S., and using that to your advantage from an optimization standpoint, I think is also super important. So I know things have been covered in these areas. Again, I'm happy to take questions on these as well when we do the Q&A, but really want to focus on sort of what else can be done. And a lot of this stuff is obviously for people that are both outside the US, but also Americans living inside the US, right? And so these sort of things can be used for both for the most part. So obviously everyone knows this. US expat taxes are very complex. You have to do a FATCA, which is reporting things to the IRS, like bank accounts, foreign pensions, foreign companies, etc. Again, you have to do a local taxation, as I alluded to before, and potential double taxation, and getting the credit in the U.S. for taxes paid outside. And again, I mean, a lot of really good, U.S. domestic accountants just aren't familiar with a lot of these expat tax benefits, and I've seen people be discouraged about, oh yeah, you shouldn't be investing abroad, it's illegal, and obviously that's all incorrect. I think, obviously living abroad, investing abroad is a great thing to do if you're up for it, but of course you do have to do the filings for that, right? And so again, there's a lot of strategies just beyond the foreign and income exclusion, foreign tax credit. So for individuals, it's things like retirement savings options, investments, of course, estate tax planning. For entrepreneurs, even more so, especially when it comes to setting your business up the right way, and the use of tax saving tools, etc. I mean, generally speaking, the U.S. tax system really does encourage investment and entrepreneurship, and so you really should be using these to your advantage. And of course, when it comes to setting up a small business, setting up in the right way. And so we've helped thousands of expats around the world saving, things like switching states, right, from California to Florida. And I think that's even important, both for individuals that are, actively working, but also retirees. Because I think if you do move abroad, and you're from a high tax state like California or New York, you do want to switch to a low tax state or no tax state like Florida, before you actually move. We've set up, of course, trusts for asset protection and estate planning. Obviously doing things like the Roth IRA conversion and rolling taxable savings into tax-free savings, or I should say, upon taking out of your Roth IRA would be tax-free versus a traditional taking it out as taxable. Things like getting a tax refund from switching filing status from somebody who's married to a non-resident spouse that would be married filing separately. If you have kids that are American, it could be head of household. So, and then of course, self-employment tax, which we'll get into. So again, our focus obviously is on doing the tax compliance, but also finding ways to optimize. And, we have over 20 plus strategies, a few that we'll cover today that go into that optimization. Just to give you a background of me, so you know what I'm talking about. I am a CPA from New York. I used to work at PwC in New York City. Then over 15 years ago, I started Online Taxman, and it's obviously grown significantly, and it's been beautiful. And so we've advised many expats, been published, of course, in articles and, in different entrepreneur groups. And my passion truly is helping people with the optimization, of course, staying in compliance, making sure that people feel good about what they're doing, and knowing that, they are really paying as low a taxes as obviously legally possible, and can sleep well at night doing that, right? And a lot of people come to me with problems, they haven't filed in a while, et cetera, and it really is a pleasure to help people through this sort of thing. So this is my passion. Let's talk about what we're going to cover today, both looking at individuals, again, like backdoor Roth IRA, investment loss harvesting, gifting, real estate. And then for entrepreneurs, the S Corp election, accountable plans, Qubit, home office stuff, then we'll get into offshore structures. And like I said, I will leave the end for questions. So if any of these topics or any of the things you want to talk about aren't covered, I want to cover and make sure that everyone gets value from this. So the backdoor Roth IRA, I think the thing is, well, let's step back. You have two types of IRAs. You have something known as a traditional IRA or a Roth IRA. What's the difference? A traditional is you contribute pre-tax, so you actually do get a deduction, so less taxable income. You put it into an IRA. It grows tax-free. And then upon retirement or whatever, you could take that money out and it's taxable. The other one is a Roth IRA, where you put the money in post-tax, right? So you don't get any sort of deduction on your taxable income. And that grows tax-free. And then you take that money out and it is tax-free, right? And the issue is with Roth is that there's limitations for high income earners, right? So then you can't contribute up to after a certain threshold. It's like 150K USD or whatnot. It depends on if you're married filing jointly. But the point is that there's still a way for people that are high income earners that say, hey, listen, when I'm older, I'm actually going to be earning more money than I'm doing now. So it makes sense for this to be a tax-free upon distribution or upon taking it out. So what can I do to do the Roth IRA? And the answer is you could do a backdoor Roth, right? Which is contributing to a traditional IRA, not getting a deduction, and then converting it to a Roth. And so you could do this every year. Part three is that you pay tax on the gains before the conversion. But of course, like if I contribute and $6,000 to a traditional IRA, then 2 months later I convert it to a Roth, I'm not going to pay tax on that because again, I put in 6 and then I rolled it over and it was 6. You can do that, and you could even do something called a mega back to a Roth. So if you contribute even more, like through your employer, right? Because $6,000 is the contribution limit for individuals. But if you are able to contribute more into an employer-sponsored plan, and then you could even mega back to a Roth even more than just the 6,000. So again, I think this is a good financial planning tip for people that want to have this Roth IRA, but are above that limit. I think that when using the FEIE, you need excluded income, unexcluded income, right? So basically, you get your first 126,000 free, but if you are, if you only earn $90,000, then and you exclude all of that 90,000, you can't do it. So you need to do a calculation where maybe if you're in the States for 30 days, you say, okay, well, actually only 84,000 of my $90,000 of income is excluded under the foreign income exclusion. So which means I have another 6,000 of quote unquote unexcluded income or taxable income. And so then let me contribute that to an IRA and roll it into a Roth. So there's a lot of ways to go about this, so to speak. I just want to give people the knowledge and the tools to sort of know what they could do, etc. Same thing with the investment loss harvesting, right? You have, at the end of the year, you look and you have a bunch of gains, and then you have a couple of stocks or funds that are down. What you do is essentially you sell those stocks by the end of the year, and then you wait 30 days. And if you want to rebuy those stocks or those funds, you can, right, under the washer rules. So every year at the end of the year, we look at our clients' portfolios, say, okay, well, what's up, what's down? You want to sell this and buy this back in 30 days. And again, reduce your cap gains by selling these assets and what's known as lost harvesting. So this should be, again, an annual thing where you do look at your stock portfolio and you look again, how many capital gains I have, can I reduce that, etc. If you have more losses than gains, then you can reduce regular income up to $3,000. So I don't know if I have $50,000 of, I had $35,000 of gains. I currently have, let's call it $40,000 of losses that I could take. I take the 40K in losses to offset the 35, and now I have quote unquote $5,000 of losses more than gains. Well, $3,000 could be used to offset your regular W-2 or consulting income, right? And then the remaining 2,000 of that is rolled over into the following year, right? So I think, again, at the end of the year, good to sort of see this, do this. Another nice important point is that, with crypto, you can do the same thing, except you don't even have to wait 30 days, right? Right now, the washer rules don't apply to crypto. I think at some point they will, but so you can literally look at your portfolio, what's up, what's down. Okay, let me sell said crypto and I can buy it back the next day. And because of that, you can also tax loss harvest for crypto and not even have to risk waiting 30 days and seeing what happens with the said stock, because you could do it pretty much immediately. Gifting, I think is another tax strategy that people, don't always think about, right? You're allowed to gift up to 19,000 as a US person. You're allowed to gift up to $19,000 per year to people, right? And up to $14 million per lifetime, and that 14 million can change, right? I mean, 10 years ago it was only 5 million, now it's up to 14. But the point is that we see a lot of people that strategically gift, especially people in international tax situations, where they can, gift, let's call it a crypto portfolio, or a stock portfolio to a non-resident spouse, and then have the spouse sell it so that they can not have to pay US taxes, right? I mean, if you're non-resident spouse, right? And when I say non-resident, like they're not a US green card holder, they're not a US citizen, of course. They don't live in the US, of course. They're not filing US taxes because they're not American. Again, you could gift a portfolio of stock, crypto, whatever to them, have them sell it, and then not pay tax in the United States on that. And then as long as if it's of course over $19,000, you can use your lifetime exemption of $14 million. So let's say, I don't know, I gifted $100 million worth of stock. Of course, I have to, file that gift tax return with the US every year. But again, I mean, that could be a major way to save US taxes. Same strategy applies to people to avoid exit tax, right? People that are looking to renounce their US citizenship. If you want to renounce, you have and you're worth more than $2 million net income, you could potentially pay exit tax. So what do? You gift assets to get under the $2 million, right? You can't do that in the same year that you gift and renounce, but let's say, again, with proper planning, you can gift it to your children, you can gift it to your spouse, whomever, and get another 2 million to avoid the exit tax. And then of course, there's estate planning, right? Where you know that your quote unquote lifetime exemption is 14 million, but you're gonna, that you're gonna run into some money, or you have, investment in a tech stock or startup that you work with that's gonna, go bonanza and push you over the $14 million exemption. So you gift it to a trust, and then you no longer own those assets, which means that even if they go above the 14 million, you're not going to be hit with the state tax. So the gifting is underappreciated, if you will, as a good strategy, especially people in international tax situations, to take advantage. Real estate, again, I think is another great strategy. As I mentioned, the US encourages entrepreneurship and investing. And in particular, investing in real estate, I think, is a great investment, and also has a lot of tax benefits, right? So, one, selling your primary residence, right? So if you live in a home, whether it's US or abroad, you live in it for more than 2 years out of the last 5 years, you get this exclusion of up to 500,000 married filing jointly, or 250K. So you will. However, the other question is, well, what about inheriting a property? Well, when you inherit a property, it gets stepped up in basis. So let's say, my parents bought a house for 100,000, passed away, and it's worth 700,000. Well, all of a sudden I get that step up in basis, so it went from 100,000 to 700,000. Then I could sell it the next day for 701,000 and only pay tax on that 1,000 capital gain, right? So you get the step up in basis. I've seen it the other way, actually, where I had a client that really, unfortunately, it was not proper tax planning. His father had gifted him half of the house, years ago. The father passed away. The house is in California, so there was a big gain, or there was a big, the appreciation. But because he was gifted the house during the father's lifetime, he inherited the lower basis, because when you gift something, you actually inherit the basis of the giftor, right, of the donor. When you inherit something, you get the step up in basis. So in this part, half of the house was his father's and had the step up, of the other half of the house was his and didn't get the step up. So that was very tax advantageous, unfortunately, for this fellow. So again, I mean, if depending on the property, depending on the asset, you might want to wait till one passes. And that's a common strategy in real estate. I keep on buying real estate, and I either flip it to another real estate and roll over the gain tax-free, which is called a 1031 exchange, or I borrow against the real estate, but I don't gift anything or sell anything until I die. And so it's called the buy, borrow, die strategy. But again, I think there's a lot of things that could be done when it comes to real estate and inheritance. The other aspect is what's known as depreciation, which again is you buy a property. Let's say the property is worth $270,000. It's a rental property. You get to depreciate it over 27 and a half years. So in this case, $270,000 property, that's the actual building's worth 270,000. Then I get to depreciate basically $10,000 every year, right? So depreciation obviously works in your favor when it comes to real estate. In fact, you could do a cost segregation study to get even more depreciation. So like I said, a house depreciates over 27 and a half years, but in a cost seg study, they look at the furniture and the fixtures, the improvements to the yard, etc. And they say, well, yes, $200,000 worth of this house is, the building, but $70,000 is the light switches, the doors, the kitchen appliances. And so rather than 27 and a half years, that 70,000 is depreciated over 5. Right, so you're sort of breaking it down into different components. And again, doing this with bonus depreciation really can front load the depreciation and save you some money, especially and going to page 2, if you convert it into either like a short-term rental or you become a real estate professional, which all of a sudden all this mega depreciation can be used to offset your ordinary or income, right? Your income from a job, from your business, earned income. So again, I mean, real estate in particular, there are a lot of ways to benefit from that by, basically taking the depreciation, doing this sort of front-loaded, accelerated depreciation and bonus depreciation, and then qualifying for the real estate professional, which means that you spend over $500,000 every year. 500 hours every year of being a real estate professional, right? Managing a property, studying real estate, etc. Or doing a short-term, going on Airbnb and essentially making it a short-term stay, like under 8 days, so that it qualifies for a business that's not considered passive income. And again, taking all the depreciation against that business, which will result in a loss, then the loss could be, of course, offset against any other income that you have from, like I said, job consulting, etc. So, in either scenario works. The real estate professional, I think it's important because you do need to really document the 500 hours. You also need to spend more time in real estate than than your regular job. So for example, in a household where one spouse is the primary earner and the other spouse is not working or working part-time, have the spouse that's not working or working less, either a real estate professional, etc. As I also mentioned, 1031 exchange, again, you have an investment property, you want to sell it, and then within 180 days, you buy another investment property with the proceeds, that gain could be rolled over. It's a deferral. And this also applies to real estate outside the US. So, you could have a house in Panama, you sell it, you buy a house in Colombia, and you could defer that gain as well. You can't do US to foreign, so I can't sell a rental property in the US and buy a rental property in Italy. I can't do that, but you could do foreign to foreign. I'm going to get into now some of the tax saving strategies for entrepreneurs, right? One thing is, again, being taxed as an LLC versus an S Corp. I think this is a big question that I see a lot of entrepreneurs that, when they first start their business, they're an LLC, but there's this notion of, well, when should I, file to be an S Corp? What even is the S Corp? Et cetera, right? So first, if you're about 40 or 50,000 in net profit, it's time to convert to an S Corp, right? And there's three things you do. One, you well, obviously run the numbers. Two, you file Form 2553, which actually is due March 15th if you want to become an S Corp as of January 1st of 2025. You can file it late, but you just have to make sure it's done correctly and there's a late filing election. And then, of course, setting up payroll, right? And we'll get into that in a second. I think one thing to beware as expats is, again, S Corps are great for Americans and well, I mean, they're actually only for Americans. You can't be a foreigner and own an S Corp, like if you don't live in the US or you're not like a green card holder or a citizen. But S Corps might not work elsewhere, right? So, for example, living in Portugal, actually having the LLC is more beneficial. So I'd always, if you live outside the US, I would check with your local provider to get their interpretation on S Corp. So what's the savings, right? So again, we have somebody, let's put it somebody at 140,000 net profit. They pay the income tax, et cetera. That's all the same. But if you have a sole member LLC, you also have to pay 15.3% self-employment tax, right? This is Social Security tax for self-employed individuals. So as a sole member LLC, you would have to do that. And then in this case, you're paying around 29,000 tax all in. So you make the election. And of that 140K, you have to break it down into what is salary and what's known as like a profit distribution. The thing is, on the salary, you still do have to pay the 15.3%, but on this, 80K net profit out of the 140, you don't. So in this case, basically, you're paying or you're saving, 15.3% on this 80,000 net profit or 80,000 in profit distribution. So again, you're achieving a 12K tax savings. So you could see, with the S Corp, the more you make, the more you save. I think the break even, like I said, is around 40, 50K, depending on the situation. Because at that point, sure, you're gonna have to pay an extra 1,000 or plus for the S Corp tax return. Sure, you're gonna have to set up payroll and do payroll. So you want to be at least saving a couple $1,000s to justify the setup and the cost of the S Corp. But once you do, again, the more you make on the S Corp, the more you will save. And then with the S Corp, there's all other sorts of cool plans and tax saving strategies that you could do. One is called an accountable plan, right? Which allows your S Corp or your C Corp for that matter to reimburse for employee expenses. So it could be things like, your home office, right? The fact that you are, you have a portion of your home. Let's say you're renting a home. I paid $2,000 a month in rent. Well, 25% of my home is dedicated to my home office. So that every month, let me be reimbursed $500 from my S Corp to me personally for a portion of my home office. I'm paying a healthcare plan personally. We'll let my S corp reimburse me every month for my healthcare expenses. So it's really about setting up, like literally doing the paperwork for the accountable plan, defining the eligible expenses, and of course, every month, documenting this stuff, the expense reports and reimbursements. So, I mean, there is a level of bookkeeping, but the cost, of course, saves you money and is validated here. The other big aspect of working and having an S corp is you get this qualified business income deduction, right? And I think a lot of accountants actually, miss this when you're doing an optimization for the salary on the S corp, because that's, I think, a big aspect, as you saw in the previous example. The whole notion is, well, the lower the salary, the better. And there is this notion of, well, what's a reasonable salary for an S corp? Of course, you can't be earning $200,000 on the S corp, only take a 20K salary. And in reality, it's actually more beneficial to take a bit of a higher salary because you get this qualified business deduction, right? And so what this means is essentially you can you want to be able to have a salary that optimizes the QBI, qualified business deduction, while also optimizing for self-employment tax. So again, I think this is a good question to ask your accountant if you do have an S corp. Hey, am I optimizing for QBI? Because it's either 20% of the net income of the S corp or 50% of the salary. So it's like whatever the lower number. So it does make sense to really optimize for a QBI as well as the self-employment tax. So again, I think a lot of this is I want to present these concepts to everyone so they understand. And then obviously, if you want to work with us, we're happy to give a consultation and analyze your situation for these type of tax saving strategies, or really just go to your accountant and throw it out there. Make sure they're doing this optimization. Because like I said, I really do see a lot of accountants that miss the QBI deduction optimization. Home office. Again, we mentioned it before. For S corp owners, you should be deducting part of your home office, reimbursing yourself through an accountable plan. But another one I think that's not as used and also missed is the Augusta rule. The Augusta rule says you're allowed to rent your house up to 14 days without paying tax on the income. So what you could do is, of course, if you're okay with Airbnb for 14 days, that 14 days could be tax-free income. If let's say you go away for 2 weeks and want to rent it out, fine. Or you could rent your house to your business. So if you have a team and maybe have a team meeting or a barbecue, maybe you're renting your house to take pictures for like a showroom. If you have products that you're selling, or a photo shoot for whatever. But the point is that your S corp pays you to rent your home, and you can do this for up to 14 days a year. You get the deduction on the S corp, and you do not pay tax on that income. Of course, you need to make sure it's arm's length. You need to actually get some comps and ensure that whatever set amount that you're renting your house to is in line with what the market is. But again, I think this is an area where we see a lot of people that don't take advantage of it. Of course, there's documentation, etc. That's important, but again, I mean, this is sort of like the blocking and tackling basics of tax savings that we see people miss, and it adds up, right? I mean, it's 20,000 of deductions here, 40,000 deductions there, and then before you know it, you've saved 10 to 20 grand. So let's go into the final part of this presentation, which is on offshore business structure. Now, a lot of the things that we just discussed do apply to expats and, of course, people who live in the States. However, when you really look to structure your business outside the US, you really need to be living outside the US, right? I think the big thing on offshore is that you can't have any management in the US, you can't have any employees, you can't have any offices, you can't have any warehouses. Of course, you could potentially, if you were managing and living outside abroad, maybe you had US employees, or you have an e-commerce company and you're selling the US, you have a 3PL or having a warehouse in the US, you could potentially do something where you have an offshore company, like, for example, in the e-commerce, a Hong Kong company that buys the products from China, then sells it to a US company, and then part of the profits is outside the US and part is in the US, something like that. But the point is that if you do an offshore structure like Hong Kong, the British Virgin Islands, and you have that structure owned by US C Corp, you can, one, pay 10.5% tax on that income, right? So normally a C Corp income will be 21% tax rate, right? But you're getting a 50% reduction, so you're only paying 10.5%. So that's one. Two, of course, having asset protection outside the US and international diversification, I think, is important. And then three is that if you take a salary from a foreign corporation of that 126K, of course, that's excluded from the foreign earned income exclusion, but also you do not have to pay any Social Security, any self-employment tax. So sort of alluding to the question before, or the scenario before with the S Corp, you don't have to care about any reasonable salary, any sort of self-employment tax, because it's just zero self-employment tax, right? You are a employee of a non-US company, hence you're not subject to self-employment or Social Security, FICA, etc. And then again, once you pay the 10.5% corporate tax, you have the option of either taking the money out and paying a dividend tax, or keeping it in the company. So there's even a tax deferral level if you just decide to keep your money in the foreign company, to sort of expand and grow, etc. So again, let's do the example here with the offshore savings, right? So same thing, single member LLC, pass through, they make 140K net profit. Of course, they're paying the self-employment tax on all of it. Sure, like they're taking 110,000 foreign earned income exclusion, but even the 30K above that is subject to income tax. So they're paying roughly 29K in tax. Now, let's say they convert to this structure. You have a C Corp that owns a foreign company. Again, you pay this 100K salary, that's subject to foreign earned income exclusion. You're not paying any Social Security or Medicare tax, because again, you're an employee of a foreign company, so it's not required. The corporate tax on the 40K profit is 10.5%, so you are paying the 4,000 or so of corporate tax. And then, if you want to take out that 40K profit as a dividend, then you're going to pay 15%, so additional 6K. And FYI, you don't have to take out that 40K as profit as a dividend. You don't have to take out that dividend. You could keep that 40K in the company as retained earnings and not pay tax on that. Any additional tax, I should say. You're still going to always pay the corporate tax. So again, even on like the non-conservative scenario, you're saving 20K tax savings. And if you do want to retain the 40K profit in the company as retained earnings, you can. And then you're really only paying $4,000 of taxes. So I mean, then you're looking at 25 grand in tax savings. And so this structure is really powerful for entrepreneurs, global entrepreneurs, like I said, that live outside the US, that don't have any US business presence. Um, and this is really what the Googles and the Apples of the world are doing. But even as an entrepreneur, you could do this as well. And so if you qualify, I mean, I think it is a very strategic tax savings scenario for people that live outside the US. Of course, as I said, every situation is different. It also depends on your residency. How is your potentially local jurisdiction going to look at it? And even, that's where, I mentioned, opening up in BVI, Cayman, Hong Kong, Dubai was hot, but now Dubai is 9% tax. It really does depend on where you live. If you live in Europe, I'd probably say open up in Estonia or Malta. You live you live in LATAM, maybe the BVI. So it really is dependent on your local taxes as well. So obviously we do this as our business. And so if anyone wants to really get in depth into your specific situation, which one of these strategies can apply. Again, there's also 15 more strategies that we go through and talk through, things on capital gains. You could invest in solar partnerships and reduce your tax. You could invest in some other equipment rental companies and get a depreciation. So this is sort of just like the tip of the iceberg. I wanted to put this together as a presentation that's fairly straightforward, although I know that this is super heavy stuff. But if you wanted a more tailored call, you could scan the QR code that goes to a link, and that you could set up a consultation. Normally it's $250 for the half-hour consultation, and within that half hour we will focus and know if we could save you money and how much. But for purposes of people attending this conference, it's $197 for the half hour. So spend a little to save a lot. And yeah, like I said, I'm going to open it up to questions. Again, this is how you scan for the QR code. I'll even leave this on as we answer the questions. But of course, you can find us at Online Taxman. That's for U.S. expat tax preparation. This sort of structuring and tax planning is also under Global Expat Advisors, which is another firm that we run. So again, we have multiple brands for our different types of clients. But again, all you have to do is scan the QR code and schedule a consultation. And of course, there'll also be an email link. So that being said, I think I've talked enough. I'll open up to questions.
Vincenzo, thank you very much for that really
You're welcome.
in-depth and interesting presentation. Lots of interesting ideas in there, and got lots of questions come in. So I'll dive right in.
Yeah.
The first question is regarding foreign tax credit, which you mentioned at the beginning of the presentation. Can that be claimed with taxes if somebody's paid foreign taxes that aren't necessarily income taxes, e.g. Spain's wealth tax? Can you claim US tax credits against those kind of taxes too?
No, you can't. You cannot. All right. So in Spain, I'm not sure, but I mean, I know that that's a great point, which is that wealth tax, we talk about like foreign tax credits. Wealth tax does not count as a income tax credit. It's actually a wealth tax, right? So things like wealth tax or even VAT, which is sort of like sales tax, if you paid that in the country you're living in, that actually does not count as a foreign tax credit on the US side. It has to be an income tax.
Thanks. Somebody else, do you have to report income on sales of personal items, such as clothes or things like that? So is that
You know,
income reportable?
yeah, generally not. I mean, I think that when it's something like a collectible, or if it's even, technically if it's like a something that was used in the business, like for example, a car, um,
Hmm.
that you've depreciated, but there's a quote unquote salvage value if you sell it, that's the sort of thing you actually would need to report as income. But if it's something like small, like clothes for personal use or something like that, I wouldn't, you wouldn't have to report that.
Okay, thank you. A couple of people have asked about the Augusta rule you mentioned and
Yeah.
whether that works. Do you have to be a US resident or does that work wherever you're resident?
No, you could do that outside the US.
Oh.
So if you have a house outside the US that you rent out for 14 days, you could still claim that income.
Okay. Can can a gift to a non-resident spouse be cash? That's interesting. I'm not sure what the is. I'm not sure if the implication is to avoid some tax there. I'm not sure.
Yeah, I mean, you could definitely do cash again if it's over $19,000. Um, then you have to report it on the gift tax return, right? And use that $14 million lifetime exemption, right? So I think again, I think the takeaway is if it's over 19K, you can you just have to report it. But also to be clear, I mean, this is a non-resident spouse. If you're a US spouse, then you can gift it to them actually unlimited, right? So for example, like uh let's say two people, an American couple wants to, gift money to their children. So, you know, one person gives 19,000 and the other person gives 19,000, right? So then, obviously you have 38,000 that you could give to each child.
Somebody has said, could I read this question in full and not paraphrase? So let's do it. If you're married to a non-US citizen, you therefore need to file as married filing secretary separately. However, using that filing status, your income limit for direct Roth contribution is basically zero. Can you do a backdoor Roth conversion via a traditional IRA?
You could, but if you're married filing separately, and if you have US children that are dependents, then you should be married, you should be filing head of household, right? And that will be way better.
That's an interesting one. A couple of other people have asked when to file married filing secretary versus head of household. And I think maybe does it depend on the circumstances and need to seek advice, see which is more beneficial.
Between head of household versus married filing separately.
Mhm. Yes.
Yeah. I mean, I would say generally speaking, head of household is better, like 9 times out of 10. But of course, the analysis is always important, and even like married filing jointly versus separately, again, you know, 95 times out of 100 joints better, but there are times where filing separately is better as well. Like if two spouses are higher income earnings.
Okay. Excuse me. Somebody says, I plan on leaving the US at the end of the year. What could I do now to prepare in tax terms? They mentioned for example, foreign earnings and income exclusion, but I guess it's a nice general question.
Yeah, no, I think that's a
Yeah.
good point. I mean, I think one thing I would do is if you are in a high tax state, to really go through the motions of switching your residency to another state, right? Getting a mailbox, even if could go there and get a driver's license, which we help people do all the time, in Texas, right? Get them the documentation so they can get a driver's license, voter registration, etc. So that they're not registered anymore in California, not taxable in California. So I think that's a good thing. Of course, like getting your visa paperwork, everything in the other country, right? So that you can show that you are a bona fide resident of the other country, not the US, for qualifying for the foreign and income exclusion. So sort of just going through that paperwork stuff. I think it's never too early to start that process.
Thank you. As a US expat, what is the best country to set up my business in order to minimize taxes?
Yeah, I mean, I think again, it depends on where you're going to be living. Generally speaking, we do like British Virgin Islands, because it's sort of a lower cost alternative. Pretty easy with the regulations and whatnot.
Okay, somebody says, I live in a high tax country in Europe. Do many of these strategies apply to me as I pay more tax in my country of residence than in the US?
Um, I think that there's some, I mean, I think that at some point it's true if you're paying a lot more taxes, in your home country, maybe not as much, but I think it's also about being able to optimize on both sides, right? So, and trying to figure out the play for optimizing locally as well as the US and how that could work together.
So they should you'd advise consulting with both a US and a local
Correct.
accountant. Yeah.
Yeah.
Um, Somebody says if C Corp taxes move to 15% next year, does it make sense to change to S to C? In what case would it make
Um,
sense?
It could. I think there's another things that we covered. I mean, if you're going to sell your business, for example, it's better to have a C corp, right? You have this qualified small business stock. So if you hold on to C corp for over 5 years, and you sell it, then you can be, your first 10,000, or sorry, your first 10 million in capital gain is tax free. So like I said, there's a lot more strategies too on capital gains. But yeah, it could make sense.
Okay. Regarding foreign real estate investments, what are available tax strategies? Can foreign mortgage interest be deducted? And can you leverage lower US mortgage rates?
So, if you have any properties in the US, you can definitely leverage that to get the cash to buy the foreign property. I see people do that all the time, or their stock portfolio. And you could still, of course, deduct that mortgage interest, whether it's in the US or foreign, against said rental property. And again, I mean, even like the cost segregation studies and things like that, they would apply to foreign real estate as well.
Thanks. Somebody says, with the foreign tax credit, what's the sequence? Would you file your non-US first and then US or reverse?
Yeah, I would file the non-US first, get the full picture of the foreign taxes paid, and then file the United States after.
Arif says, does a business in Puerto Rico or another US possession count as outside the US? Is it a foreign business or?
Yes.
Yeah.
Puerto Rico also has some really unique tax strategies. I mean, we talked about, the 10.5% for setting up outside the US, but if you set it up in Puerto Rico, it's actually less than that. It's like 5%. So, Puerto Rico, and then there's also things with, no capital gains in Puerto Rico. So you just need to spend at least 6 months out of the year in Puerto Rico, right? So everything sort of comes with a price or sacrifice. So yeah, but be aware. But Puerto Rico is also a great tax savings jurisdiction.
Somebody else, what advantages would changing a small LLC to an S Corp or C Corp if you live in Switzerland have? And they say high revenue but low profit.
I mean, I'd have to double check on how that works with the Swiss, the Swiss tax treaty, right? I think also depending on what canton you live in Switzerland, you could be paying 8%, right? So then it's like, is it even better just to set it up through Switzerland or in Switzerland? So
Yeah, it's a lot of these are, I think, a case by case basis, and you need to
yeah,
reach out, get some advice for your circumstances.
one person asked, just can you repeat the best states to set up residency? And so they're the no tax states. So Florida, Texas, Nevada, those are sort of like the top three. Washington State's another one.
Nice. You mentioned that S Corp is not as beneficial as a regular LLC in Portugal. And why is that?
I think the way that they tax the S corp has to do with that it's not considered transparent. So I think that you ultimately would pay corporate tax in Portugal on the S corp, something like that. I forget what it is. I think it's also the LLC is you pay the 15% self-employment tax, right, under an LLC, but that's actually a lot less than what you would pay like Portuguese equivalent. So that's another reason why an LLC actually works better there.
Somebody says, can you take the foreign earned income exclusion and foreign tax credit, or is it one or the other?
You could take, well, you can't double dip, right? So like, for example, let's say I make $150,000. I take the 126 foreign net income exclusion, and then that leaves me with like roughly 24,000 unexcluded income. Now, if I paid, whatever the proportion amount of foreign tax I paid on that 24K, yes, I could get that foreign tax credit, but I couldn't get the full credit on like the full like 150 because I excluded most of that income.
Here's an interesting one. There are countries with different tax years, such as the UK, I think Australia, I think there are quite a few of them.
Yeah.
So in terms of claiming the foreign tax credit, if you've paid, for example, UK tax from April to April, how does that calculation work? Or how do you prove the tax you've paid within the calendar year to claim the foreign tax credit?
Yeah. So there's a couple ways to do it. If you do like cash basis on the foreign tax credit, then it's literally like, okay, whatever I paid in said calendar year. Or you could do like accrual, and then you have to sort of just accrue and calculate for each year what the accrued taxes were and do it that way. So it's always a little tricky, candidly, with UK is a shining example because it's April to April, but you have some options. You just have to, again, sort of look at it on a year-by-year basis, calendar year.
Right, so we're coming up to the hour, but just maybe do one or two final questions. Somebody says, if I was gifted property in Costa Rica and it was valued at, for example, $1 million, and I sold it for 1.1, not having lived in it, is the capital gain 100,000?
Yeah, I mean, if you sold property in Puerto Rico and you didn't live in it, yeah, it would be subject to capital gain.
Yeah, because it was valued at $1 million, you sold it for more. So yeah, that's the capital gain is different. Yeah. And I saw another one just to finish off. Yeah, have you seen expats get in trouble because they kept a US address on US financial accounts?
No.
Hmm.
And I think a lot of times that's a fair point, which is that, Americans, I mean, I live abroad, so I understand that, we face certain challenges. So, having a US address for things like, bank statements or brokerage, it's okay. What I would be cautious of is making sure that address is in a no tax state, right? Because I've seen this all the time where somebody they have their brokerage statements or even a tax form linked to a California address, and then California says, "Oh, you're still, not you're still a California resident."
Well,
So I think that's another preparation as far as like, hey, getting your addresses correct outside the, again, in a low tax state and whatnot.
well, you're getting ready to move
I'll do
abroad.
two more just because I see in the chat. One is, are U.S. citizens required to report physical precious metals held overseas? So you're not if the precious metals are in like a vault that you don't control, right? So any sort of like precious metals or even real estate that's in your name, but overseas, you don't have to report it. Of course, like again, the capital gains is reportable. And if it's like jewelry, it could be considered a collectible or whatever. So it's taxed at a higher rate. So be aware of that. And then there was one more about oh yeah. Gifting to non-citizen children. Yeah, you could gift to them, of course. If it's over $19,000, you would have to report it on the gift tax return.